Welcome to Financial Detox. We're your hosts, Jason and Alex from IDA Wealth. Your financial journey of pursuing better and true financial peace of mind starts here. Hello and welcome to Financial Detox. I'm your host, Jason Labrum, and I'm in studio with Alex Klingensmith today. What's up, Alex?
Hi, everybody. I'm Alex Klingensmith. We are going to talk today about AI stocks and is this the next dot-com bubble? It's a topic that's going around everywhere the past couple of years, at least ever since ChatGPT kind of hit everybody's computers and cell phones and devices. And now it's a real thing. It feels like a dot-com bubble in many ways. In many ways, it's completely different. So we're going to dive into that. Jason's going to give insight into IDA's investment committee's perspective on the topic. And we're going to talk about what we've been talking to clients about for many years now, and especially in recent events.
Yeah, it's a good one, Alex. And I think we have a lot going on in the world right now with military operations in Iran. And we have this whole new technological revolution, the AI revolution and what's happening there. So it brings up the question. I mean, people still remember the pain, right? I mean, we have clients that we talk to all the time, right, Alex, where they talk about, or prospective clients, about how they lost money in 2000 or how that was such a tough time for people. Some people don't even remember it because they weren't even invested at that time, but it was a real event. And it was, I would say it was a paradigm event for what either made people successful investors because they did things correctly and they had a philosophy to rely on during that time, or it destroyed people. Where I can think of a client we're bringing on board right now who is still suffering from the psychological effects of how much money they lost during that time because they did change their strategy when things were ugly. And they went from, I'm a go get it, technology growth investor to, I can't handle this, I want out, which means they sold at the bottom and got conservative and said they were going to wait till things get better. And here it is, 2026. And they're thinking maybe things are better now. This is literally 26 years of psychological investment damage that happened to them.
It's funny you mentioned the word psychology because so much what we do is psychology. And I'm rereading the book Psychology of Money by Morgan Housel with a couple of our colleagues right now. And it talks about that exact thing, is that your perception of investing has a lot to do with when, how old you were in certain major market events. And your story, your personal story as an advisor and now, founder and CEO of IDA is very much in line with the events of the dot-com bubble is when you started. And I don't want to tell your story for you, but it felt exciting. The internet was changing the world. A lot of people made money really, really fast in a very short amount of time because of this technological evolution. Sounds like AI, right? That's the part that sounds very, very similar. And you, Jason, were starting in this journey as out of college right around the same time, right?
I mean, literally, it's, I started in the business in 1998. And then I became an advisor, quote unquote, advisor in March of 2000. Like you couldn't pick the top of the market, right? You couldn't find a time that was more not great to become an advisor. So it was interesting, and I've been right in the heart of this and can understand it. So, Alex, the question that you've asked is this
a
repeating
history?
Are we back here? I think that our producer and marketing partner here, Christy, has done a good job pulling up a couple really relevant slides and data. And so I'd like to touch on those for a minute. And I think the first one is really good. And it's like the hype cycle looks familiar is what this chart is entitled. And we'll throw it up for you here on the screen so you'll be able to see it. Pretty interesting how when you look back at what's going on from different valuation metrics and how large these positions have become inside the S&P 500, it's pretty interesting. If you look at the AI bubble, in this chart, you see kind of a light gray version there, and you see that the top 10 stocks accounted for almost 30% of the S&P 500. I think we're actually talking about a multiple here of PE. We are. So we're looking at a 12-month PE. So you look at the top 10 stocks, gets up to almost 30 times earnings. And you go back to the IT bubble, that was 25 times. So from a pure, if we were evaluating this purely based upon a 12-month forward PE ratio, well, then, yeah, we're in not only
we already surpassed it.
a bubble, but worse than the last bubble. That's scary.
Well, it's scary too because it's such a concentrated risk, which is what you're actually, it forced you to think about what this even means in terms of the top 10 versus the other 490. And if you count the NASDAQ, it's probably even more concentrated, right? Like
Yeah,
quietly building.
I think we can get this chart. So we'll throw this one up too as well. When you look at the S&P 500, not only are we talking about here the valuations, but I lost my train of thought. Let me pull it back together here because I'm thinking about 10 different things at once.
It might be the next chart, actually. The 10 largest companies as a share of the S&P 500 total.
Let's go there because it's really interesting regardless. Yeah. And if I catch my other train of thought, I'll bring it back to us. But when you look at this number, you think you're diversified by owning the S&P 500, but you're not as diversified as you think you are, right? 37% of the S&P 500 is the market cap is made up of the top 10 companies. So that's scary. Now, when you look at March roughly of 2000, when the market, the IT bubble or the internet bubble burst, if you owned the S&P 500 for the next 10 years, you were negative, right? If you bought it at that time, you were negative. So when you see signs of, or you ask the question, are there signs of this repeating? Yes, there are definitely signs of repeating, but there are really easy ways to protect yourself too. I don't think anybody wants a 10-year negative rate of return, but it was 9 or 10 years where the S&P 500 was negative. If you bought it around March of 2000, which a lot of people bought at the top.
And a lot of other parts of the markets, especially internationally, were not negative. So if you look at that negative 9% over 10 years for the US, large cap growth, that asset class versus like international and emerging market and even small cap, US small cap, right? A lot of the other ones were positive. But hang on, let me. You asked me to debate with you a little bit, make this interesting.
Okay.
I disagree.
Here we go. Let's do it.
I disagree that it's similar enough because I think the companies those top 10 companies and more right now, that's different than back then. Right now, they actually make money. They're actually making real money because investors, like all of our clients, like everybody out there who's an investor in public and private markets, they're buying and building data centers, they're buying and building chips, and there's real profitability happening within these companies that have gotten so big and maybe bloated. Whereas maybe rewind to 2000 or to 1990, late 90s, investors were betting on ideas. The companies weren't actually making money yet. Some of them disappeared completely. Some of them went on to continue to be really successful, like Google, Alphabet, right?
Right.
For example.
Who's now participating in the next wave, right?
They hung in there. They survived the last bubble. Right?
I think you make a really good point. And there's clearly, demonstratably some connection to not only earnings per share, which we have a decent chart on, but when you look at like earnings per share now versus, and this is a short-term chart, just going back to 23, earnings have gone up substantially because of these builds for AI. And thus the PE has gone down. Even more so if you look at as of late, because what's an interesting chart as well is the fact that the S&P, if you look at the sweetheart stocks, the Magnificent Seven, it's really not the Magnificent Seven anymore. It's now the Magnificent Two. And there's only two stocks, Google and NVIDIA, that have now outperformed the S&P 500 over the past year to date. Only two stocks right now are in the green out of the S&P 500 Magnificent Seven. So things have started to already change. Is this bubble already bursting and presenting itself? But yet, funny how you still have Google in the hunt, which was part of the internet bubble as well, right?
I think they're smart to change their name. So now they're under the next version of Google, right? It's Alphabet's journey now. I think it's interesting too to like talk about what those that you mentioned a client, right? Who went through this 26 years ago and just is still traumatized by that experience. Psychology of Money goes through a lot of these examples in history. Different generations have different perspectives on investing because of what they lived through. World wars, official world wars like World War II, and what happened during that time. And that's like my grandparents' generation. Like they became extremely frugal, extremely risk averse because of what they lived through versus like somebody who's like, oh, I'm going to pick on my little brother because he's easy to pick on. He's the generation after me. I'm like sort of a millennial and he's sort of a whatever's millennial and then a younger even on the cusp of that one. I mean, as far as he's concerned, there's never been a bad investment period so far in his life. So he's like, everything goes up. And you're like, no, dude, it's not how it works. You want to be able to manage your risks through these things like concentration risks, like be diversified into public and private investments, have different asset classes and different fundamentals or factors. He's like, no, I'm just going to buy tech stocks. It's all good. AI. Now they don't even call them tech. They call them AI stocks.
Yeah, the worst was if you were invested in the NASDAQ, you had a 17-year period in the NASDAQ 100 where you were underwater. In March of 2000, it took you 17 years to get back to positive in the NASDAQ 100 tech stocks. So you want to talk about a long, dry run for your brother. Like he's just not going to survive 17 years with patience and discipline if he's losing money. So that's where the problem comes. And I think we got to, as we kind of wrap this, right? We've shown you some charts and some slides. What's the answer, right? Like, what is the answer? Is this a dot-com bubble just appearing again? I think the answer is probably yes. My answer is yes, it is. And if you don't have diversification in your portfolio, and if you're focused on one or two stocks, they better be the right ones. And if they're the right ones, you're going to come out a big winner, right? If you bought Amazon in the beginning or you bought Google, you are a huge winner. Multiple other stocks we could talk about. Maybe it's NVIDIA. Maybe it's not. Maybe NVIDIA is the AOL. Because remember, AOL went up 25 points a day.
Who?
And yeah, and it's gone. So we don't know. And that's the problem, is trying to forecast and bet with thousands of variables affecting it, which stock's going to be around. If you're not willing to cut losers, hold on to the winners. If you're not willing to build an investment philosophy around that, you're probably better to build diversification, have exposure to it, but trim and balance that exposure so that you don't get caught in a 9 or a 15-year drought. And we'll show both those charts because I do have the one that I was just talking about where Magnificent 7 over the last 12 months, 1 year, has become really the Magnificent 2. All the other stocks have underperformed the S&P 500.
So you know what I would have wished
crazy.
if I was old enough in 1999, 2000, because you're much older than me, right? So
Way
I
older.
don't even know. I don't even know what was happening back then, but I was graduating high school. Actually, I was. I wish, though, that back then, if I could rewind time, jump in Back to the Future and into DeLorean and go back, I wish I could have had access to the private markets for the reason of being early into what was going on back then, which is possible now more than it was then. 26 years ago, it was really hard to be in those small closed door environments where you could be a private investor in some of this new, great, cool stuff that everything went up billions of percents or whatever. Now you can kind of do that. I mean, to some degree, right?
You totally can. And we're not going to talk about specific investment products because it opens us up to a whole new approval process for compliance. But there are products and ways that you can get diversified into alternative assets. And what's happened here, we'll summarize and kind of wrap on this, right? There's definitely a valuation problem. If you look at the last 12 months and you take the Magnificent 7 and only 2 of them have outperformed the S&P 500, I think that's the sign, that's the writing on the wall, right? Apple, Tesla, Amazon, Meta, Microsoft, all below the S&P 500 performance for the last 12 months. Only 2 of the Magnificent 7 have continued to outperform the S&P 500 over the last 12 months. I mean, the bubble's for all intents and purposes bursting, but if you can pour into getting access to companies that are maybe not even public yet, that are leading this, things have changed. And the paradigm shift has been that publicly traded companies or companies would go public because that was the next phase of capital. Once you got so big, you needed to go public to have more capital to continue to grow R&D, development, hire people, and become this big company. But that's not the case anymore. And that's really not the case over the last 10 or so years, which is why you've seen public stocks, the number of publicly traded stocks going down. And that's because there's less IPOs and less companies going public because they don't have to go public. They literally can get that next round of capital financing and that next capital event from the PE market, the venture capital markets, or the private equity markets. So they tend to stay private longer. So as an investor in the public markets, you're missing out on those upside returns if you don't have exposure to private markets. So that's the key, and why I think you would want to have that as a piece, not a total, but a piece of your portfolio, is you would want to have exposure to companies like Anduril and OpenAI and SpaceX, Anthropic and Claude. I mean, those are companies that, to have a really good portfolio today, I would say you have to have those companies.
And the next wave of them that's coming already.
That's right. That's it. So be careful, right? Invest intelligently, be smart, have a philosophy, stick to it. If your philosophy is to buy tech stocks, great. But make sure you have a philosophy to move in and out of the tech stocks, or to get rid of the ones that aren't working anymore, because you could hold losers for years and years and years and years. It'd be better to take the tax loss and move to what's working. We can help you do that right here at Financial Detox. That's what our team does. The investment team behind us is IDA Wealth, and IDA Wealth helps thousands of clients invest their portfolios, diversify, build financial plans, get exposure to alternatives, all the things that you heard Alex and I talk about on this show. Right, Alex? That's where we're at.
It's great.
Okay,
Email
perfect.
us.
On that, we close. Check us out. Give us a like, follow us, all that good stuff. Thanks for tuning in. It's Financial Detox. I'm Jason Laban. We'll catch you on the next show.